Hello everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics behind a short squeeze. Ever wondered what it means when a stock becomes incredibly expensive to short? Well, we're going to use a real-world example to break it all down. Inc., ticker symbol ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD logo/stock chart. Let's get straight into our spotlight stock. ZCMD, or Inc. This company operates in the healthcare and health information services sector, specifically within the People's Republic of China. Their primary business revolves around providing healthcare information, education, and training services to medical professionals, mainly through their Endemi brand. They also have a segment dedicated to the sales of patented drugs. ZCMD is a microcap stock with a current market capitalization of just $7 million. This small size is often a key characteristic of stocks that exhibit extreme volatility and, potentially, short squeeze setups. What is cost to borrow and why it matters? Before we get further into ZCMD, let's quickly explain some fundamental concepts for our new viewers. When investors short a stock, they're betting its price will fall. To do this, they borrow shares, sell them, and plan to buy them back later at a lower price, returning the borrowed shares and profiting from the difference. But borrowing shares isn't free. There's a fee involved, much like interest on a loan, and that's what we call the cost to borrow, or CTB. Why does this matter? Because a high cost to borrow indicates that shares are scarce and in high demand by short sellers, meaning it's expensive to maintain a short position. When this fee skyrockets, it puts significant pressure on short sellers to eventually cover their positions, potentially fueling a short squeeze. These fees can even exceed 100% annually when supply is extremely limited, as we'll see with ZCMD. Why this stock is hard to borrow right now. Now, let's talk specifics about ZCMD. This stock recently appeared on our hard-to-borrow screener for a very compelling reason. Its cost-to-borrow fee is an astounding 846.6% annualized. Show CTB percent on screen, that's one of the highest we've seen, making it incredibly expensive for anyone to short Inc. The estimated float for ZCMD is a mere 1.1 million shares. A small float means there are very few shares available for trading in the open market, and even fewer available to borrow. This scarcity is a primary driver for such an extreme cost-to-borrow fee. While the exact number of shares currently available to borrow is unknown, that 846.6% CTB strongly suggests they are extremely hard to find. Our internal composite squeeze score for ZCMD currently stands at 47.5 out of 100, indicating a moderate but noteworthy setup. Looking at recent price action, ZCMD closed today at plus 5.56%, and over the last 5 days, it's gained plus 7.55%. However, it's still down minus 4.20% over the last 30 days. Volume today was 1.73 million shares, which is significantly lower than its 30-day average volume of over 10.5 million shares, giving it a relative volume of just 0.2. This lower volume could mean less liquidity and potentially exaggerated price movements on low share counts. Squeeze mechanics explained. So, what exactly is a short squeeze? It's a scenario where the price of a stock suddenly jumps, forcing short sellers to buy back shares to limit their losses. This buying action, in turn, pushes the price even higher, creating a snowball effect. The trigger can be anything from positive company news, unexpected buying pressure, or simply the cost to borrow becoming unsustainable. When short sellers are forced to cover, they become buyers, and in a stock with a small float and high CTB like ZCMD, this can lead to dramatic, rapid price increases. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One of the biggest risks to any potential short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This increases the supply of shares, often pushing the price per share down and making it much harder for a short squeeze to take hold, even if the cost to borrow is high. For ZCMD, we've checked recent SEC filings and found no recent dilutive -1, -3, or 424B filings in the last 90 days, which is a positive sign for any squeeze thesis. Recent reverse split watch. Another important factor for ZCMD is its recent reverse stock split. On June 29th, which was 42 days ago, Zhongchao Inc. executed a 1-4-3 reverse stock split. A reverse split reduces the number of outstanding shares and resets the share price higher proportionally. While this often aims to boost the stock above minimum exchange listing requirements, it also significantly reduces the float. Highlight float on screen. Many microcap stocks historically tend to see renewed volatility or even a price pop within about a month after a reverse split, though ZCMD is slightly outside this window. This is an observed pattern in some microcap names, not a guarantee, but it's an important aspect to consider when looking at ZCMD's current setup. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For ZCMD, given its incredibly high cost to borrow and small float, here's what astute traders might be watching. Continued high CTB and any further decrease in available shares to borrow would certainly intensify pressure on shorts. Keep an eye on any significant increase in daily trading volume, especially if it's sustained and above a 30-day average. Any positive news from Zhongchao Inc. regarding its healthcare information services or patented drugs in China could also act as a catalyst. Given the minuscule 1.1 million share float, ZCMD is highly susceptible to volatility both up and down, even on relatively low trading volumes. Zhongchao Inc. ZCMD presents an intriguing case study with its astonishing 846.6% cost to borrow fee and tiny 1.1 million share float. While these factors create a textbook environment for potential short squeeze conditions, remember that nothing is guaranteed in the market. Always conduct your own thorough due diligence, understand the risks involved, and consider your investment goals. If you found this breakdown insightful, please hit that like button, subscribe for more in-depth analyses like this, and leave a comment below with your thoughts or any questions you have about ZCMD or hard to borrow stocks. Thanks for watching, and we'll see you in the next video.